A very warm welcome to all the distinguished speakers, participants in today's webinar, which is based on the topic GST and customs related proposals in Finance Bill 2025. Today's webinar is being organized by DGTS Delhi Zonal Unit and Calcutta Zonal Unit. And I'm Ravindra Joshi, Additional Director, DGTS DZU, and I will be the moderator for today's session. And this webinar promises to be a valuable session as we explore today's topic. To start off, I would like to extend a very warm welcome to our ADG Shri Amish Kumar Gupta sir, who is holding charge of DZU along with the KZU, Calcutta Zonal Unit. Sir has been a guiding force in all our efforts to enhance taxpayer services and has continuously provided leadership in our various webinars. Now we are privileged to have an opportunity to gain insights from his vast experience and knowledge. Now I invite Shri Amish Kumar Gupta sir to deliver the welcome address. Sir.
Thank you, Ravinder. Good afternoon to all the delegates and the guests who are appearing in this webinar. This is, as you all know, that last year also and before that also we have been conducting webinars on different topics related to GST and customs. Our main focus always is to bring different topics into the domain and for the knowledge of the SSCs, where there are some issues or where they face some problems or where they need to get some insight. Last entire year we were we organized webinars on topics like different recommendations of the GST Council, the AEO and related issues of customs, drawback related issues of customs. The last month we had this webinar which was very well received, which was on the topic of tourism and travel, provisions of tourism and travel, which was also very well received. So DZU and both KZU, we circulate these our webinars, our details of webinars to different trade associations as well as among our officers, so that they can get the benefit of it. Mostly we get about average about 500 delegates in each webinar. So in that way we have been able to reach a vast area and vast number of people in last 1 or 2 years. So this has always been an endeavor that we whatever is the latest we bring it into the people's domain. This time obviously every year this budget thing is there, although the budget, a lot of major part of the budget has gone into that GST Council arena only now. Very few topics, very few CGST related issues come into budget in for the yearly budget, as well as the customs issues. So this time we have taken this finance bill proposals for this particular year 2025, and this time our partner has been Bengal Chamber of Commerce, Shri Vivek Jalan. First time Vivek Jalan is here as a participant in this, and although earlier also we have been we have a partner as Bengal Chamber of Commerce. Vivek Jalan is the chairperson of National Fiscal Affairs and Taxation Committee and the Bengal Chamber of Commerce. He represents Bengal Chamber of Commerce. So this time he has taken up this mantle to deliver this address here. And last but not least, I'll extend a warm welcome to our keynote address person, Sri Mahendra Ranga. I had the benefit of he's the holding charge of Chief Commissioner Jaipur Zone just now. He has been last month only has been promoted to as Chief Commissioner of Principal Chief Commissioner. My hearty congratulations to Mahendra Ranga sir, and I had the benefit of working with him for some time during my career, and I must say that he is one of the most knowledgeable and one of the most very I'll say a great mentor also. He has been a guiding force for me during my career. And I had attended his lecture also on the provisions of prosecution and arrest and such provisions of Customs Act. And it was delivered so well that I still remember the provisions very well. So I extend a warm welcome to Shri Mandaranga also. So on this note, let us carry forward the webinar. Ravinder.
Sir, thank you, sir. Your words have set a strong foundation for today's webinar. Thank you again. Now I'm very happy to share today that we have with us Shri Mahinder Ranga sir. Sir is an IRS officer of 1990 batch and is currently serving as Principal Chief Commissioner of CGST in Central Excise, Jaipur Zone. Sir has a very versatile and dynamic personality. Sir has started his career with Indian Revenue Service in Barmer, Rajasthan on anti-smuggling front on Indo-Pak border. And thereafter, sir has served in various positions at various places in the country. Sir has been associated with several important initiatives of the department like computer assisted audit, new audit system undertaken in collaboration with Canadian authorities and many others. As a master trainer of GST, Sir has conducted many workshops, workshop talks related to GST during the GST rollout. During the GST rollout, Sir is also a regular visiting faculty at the National Academy of Customs, Excise and Narcotics and various other institutions and academies. Sir also has penned a book titled Morning Musings, Sutras for Success and Happiness in August 2022. Sir has received multiple commendations for his outstanding achievements, notably from the High Commission of Canada and Estimates Committee of Parliament of India. Now I request Sir to kindly enlighten us with few words of wisdom. Sir.
Namaskar and good afternoon. I hope I am audible.
Sir.
At the outset, I thank Amish for the anchor for the kind words for me. And so far as the seminar is concerned, I compliment DGST and the full team and their partners for organizing it. These seminars are genuinely needed and appreciated by the trade. Taxpayer education is an important function which we need to pay attention to. At the outset, this budget is a wonderful budget, especially the indirect taxes part. This is another step in the direction of a Viksit Bharat as envisioned by our leader and the Prime Minister Shri Narendra Modi ji. A Viksit Bharat will need a GST which takes care of all the concerns, the issues, and the GST will have to evolve with times. These provisions are a step in that direction. They evolve the GST law and procedure further to align it and to make it congruent with the needs of the times. There are, as Amish has already mentioned, so far as GST is concerned, the exercise, the budget making, the provision making exercise has shifted to GST Council. And we have been denied much of the suspense and the drama that used to involve revealing of the budget. Nevertheless, what happens in GST Council has to find way in the Parliament of India, and the decisions, so far as they require change of legislation, they have to come to the council. We can commend ourselves so far in evolution of the GST law. It has served many the aspirations of the people, and the good thing is that the council has been very proactive so far as meeting the requirements are concerned. This budget has mainly about 11 proposals relating to GST. There is a provision relating to, there is an amendment relating to ITC for input service distributors. This clarifies the position for availing credit so far as interstate transactions are concerned. This is a trade facilitation measure, and much of these provisions are either for trade facilitation or streamlining compliances. Some of the provisions are intended to prevent evasion. So this provision relating to the input service distributor or ISD aims at trade facilitation. A clarification on local authority has also been provided relating to municipal and panchayat areas, which is a legal streamlining. To prevent evasion, a track and trace system for specified goods will be launched in future, and the necessary enabling provisions have been brought in the law. The time of the vouchers had been a cause of lot of questions. The government had issued a clarification to outlining various issues relating to vouchers, and those clarifications now find a place as part of law, because it will be much easier now to provide authority to what was being done through a clarification. A major change about definition of plant and machinery is also being made. Two terms had been used in the law: plant and machinery, plant or machinery. At most places it was plant and machinery, but at one place it was plant or machinery. And we had the Supreme Court judgment in the Safari case. And this amendment has been brought in to align the law with the original intentions of the legislature. Credit notes or debit notes are an important feature of trade practice. Issuance of them requires adjustment of the ITC liabilities. So far it was obligatory on the issuers to make these adjustments, but now it is being made mandatory by law that whenever the credit note is issued, the corresponding ITC will have to be modified, and this obligation has been cast. It will no longer be only a moral obligation, it will be a legal obligation. There are some changes in the return mechanism which align the system with the invoice management system, which is going to be future of the modern GST. We have launched IMS some time back, and in future there will be much more utilization of IMS. Some changes have also been made in the definition for supply that relates to SEZs and free trade zones and warehousing zones. As we know that before the goods are cleared in TTA, they may change hands many times. And as per the current practice, GST was leviable on these transactions, which is against the intentions and the scheme of SEZ and free trade and warehousing zones. So a change is being made to clarify that such transactions will neither be supply of goods nor supply of services. A 10% mandatory pre-deposit for penalty-only appeals is also being introduced so that frivolous litigation is reduced. On the custom side, there is rationalization of customs tariff. An important change is being made by providing an outer limit for finalization of provisional assessments. Now the provisional assessments will have to be finalized by within 2 years. There is a new time limit for refund claims. The settlement commission is proposed to be abolished. And in the meantime, for the interim period, there will be an interim board. Overall, the direction of the changes is to promote a culture of compliance, and the government wants that much of tax payment should take place through a culture of compliance and not through enforcement measures. So these provisions intend to make that culture of compliance, because a culture of compliance requires that the procedures are simple, the rates are reasonable, dispute resolution is quick. So these we should facilitate the genuine taxpayer, and those who are trying to evade, they must be dealt with sternly. So these provisions are go a long way in contributing to the culture of compliance, which has been the motive and the aim of the government. So this is the background to these changes, and Advocate Vimal Shri Vivek Jalanji will elaborate them further, and we will be able to go into the details. But to summarize, this is a great budget. This is a wonderful budget, and these indirect tax provisions are a step in the direction of Viksit Bharat, and I hope we will evolve a GST law and procedure which fosters our journey towards a Viksit Bharat. Thank you, Jai Hind.
Thank you so much, sir, for sharing your valuable inputs. And we also look forward to for your participation in our future webinars as well, sir. Now I would like to introduce and invite Shri Vivek Jalan for today's presentation. He is a distinguished chartered accountant, a qualified LLB, LLM, MBA, and a taxation expert with 20 years of experience. Shri Jalan chairs the National Fiscal Affairs and Taxation Committee of Bengal Chambers of Commerce and Industry. He is a renowned author and a guest faculty member sharing his experience with top institutions and media platform. A trusted voice in taxation, Shri Jalan provides insightful guidance to professionals and governments alike, helping them to navigate complex tax laws and regulations with ease and clarity. Welcome, Shri Jalan, and over to you for the presentation.
Thank you, sir. And first of all, good afternoon to all the distinguished panelists over here and all the participants who have joined. Shri Mahinder Ranga sir, Principal Chief Commissioner, CGST, Jaipur Zone. Shri Amrish Kumar Gupta, ADG, DGTS, CBIC. Shri Ravinder Joshi, Additional Director, DGTS, CBIC. DGTS, KZU, Kolkata Zone, and all the other distinguished panelists over here. Thank you for providing an opportunity to Bengal Chamber of Commerce and Industry for participating in this webinar with the CBIC on the indirect tax reforms and the changes in the Union Budget 2025 which have been proposed. The Bengal Chamber of Commerce and Industry is the oldest chamber of commerce and industry in India, and its inception dates back to more than 150 years. We have been extensively involved in even the drafting of the customs law of India, and during the GST implementation, we have tried to engage with the government as well as trade and industries equally, so as to try and provide a seamless GST implementation for our country. And this Union Budget 2025, as presented by the Honorable Finance Minister, and as far as the indirect tax proposals are concerned, as Honorable Chief Commissioner Sir has said, the GST proposals have been by and large discussed and have been ratified by the GST Council. Customs proposals also. The direction of this budget as far as the GST is concerned and also customs is concerned is very apparent that towards the most important word which is used again and again in the economic survey is deregulation and self-compliance, self-assessment. We also from the Bengal Chamber of Commerce and Industry appreciate and hail this budget, especially this Jan Vishwas 2.0, where it is also sought going forward to decriminalize, deregulate so much of the taxpayers' compliances and other areas in this budget for the indirect taxes which have been presented. I will take forward for all the participants over here. I'll just share the PPT. Sir, is my PPT visible?
Yes, it is.
Thank you. So, I will start with a small macroeconomic perspective from the budget. And again, it is a great budget as far as the economics is concerned. Also, it is a budget of 50.65 lakh crores and related to a tax revenue of 28.37 lakh crores. And also, the fiscal deficit is kept in control at 4.4%. So the government has done a great job as far as the fiscal deficit is concerned. It has reduced from the last year also. As far as the revenues of indirect taxes is concerned, for the GST part, there is a budgeted growth of around 11% overall. So as you can see on your screen, for CGST, from the last year's revised estimate of 9.08 lakh crores to 10.10 lakh crores. GST compensation from 1.53 lakh crores, the current budget is 1.67 lakh crores. So overall, a GST budget has been done with an increment of 11% over the last year's revised estimates. What does this 11% mean? If we see that the GDP growth rate of India is around 6.5% estimated for financial year 25-26, and the inflation is 4.5%. So taking together, it comes to around 11%. Therefore, the government, it seems from the indirect taxes front, wishes to, grow the GST revenue as equivalent to the growth of the country, the GDP and the real growth of the country, right? GDP, which is inflation adjusted. So far as the customs revenue is concerned, the growth is estimated to be flat. This is because, as Honorable Finance Minister has said, that the Exchequer will lose 1 lakh crore rupees for the implementation of the direct and customs proposal. So in customs, we have seen a lot of rate rationalization, but what goes out in the customs, it also comes back to the economy in terms of higher GDP growth and in terms of more consumptions of goods and services and consequent increase of the GST revenue. Now coming to the goods and service tax proposals, as Honorable Chief Commissioner Sir has said, that there are around 11 proposals in the budget as far as GST is concerned. I would go one by one and deliberate on all the proposals threadbare, to the best extent we can understand from the budget proposals, and in future primarily how trade and industry should prepare for these changes. First of all, RCM through ISD. Now, input service distributor. ISD is input service distributor. Till now, till say 31st of March 2025, the cross charge as well as ISD both are allowed, right? So there was a confusion earlier, right, till 2024-25 or so, that whether cross charge can be done instead of ISD. The word cross charge is not defined anywhere in the GST law. It was a procedure which was devised by certain sections of trade and industry. Many of the times from the Chamber of Commerce in our committee meetings also, we had trade and industry talking about cross charge. We were always of the opinion that this cross charge would not to be the right way of distributing common credit. What is cross charge? Say example, you are a multi-state registered entity. You have your registrations in Maharashtra, in Rajasthan, Delhi and West Bengal, right? You are registered in 4 states with your head office in Jaipur, Rajasthan, right? Now you get an auditor, statutory auditor's bill of say 1 lakh plus 18,000 rupees GST. Now this statutory auditor provides the services, is statutory audit services to all the 4 states you are registered in. Therefore, many of the taxpayers, they were devising a formula where Jaipur, that is Rajasthan, would raise a cross-charge bill on the other 3 GSTINs. This was not the correct procedure, but still, as per Circular 199, it was stated that even cross-charge, just because it is a procedural hitch, may be accepted. Now, the government has said very clearly that from 1st of April 2025, all such multi-state registered taxpayers, they have to mandatorily take input service distributor registration for the purpose of distribution of the common input tax credit. Now a question came that okay, common input tax credit, whatever the supplier of services they bill to us, we will route it through input service distributor return, that is GSTR 6. But what about when we pay RCM, right? Say for example, this in my example, company is a multinational company and the mother company is in United States of America. So the company in India, it pays a royalty to the mother company in USA. Its royalty is that is a requirement of payment of reverse charge GST on import of services on this royalty. Now the question was as to, because this royalty is paid for all the 4 branches in my example, how to distribute it through input service distributor mechanism. Because in ISD mechanism, you cannot pay GST, you can only distribute the GST. So this amendment in section 2 subsection 61 of the CGST Act and section 20 of the CGST Act, also as per in rule 39(1) capital A, all 3 read together, the government has tried to clarify this issue. And in simple terms, what has been clarified is, in my example, since this company's head office is in Rajasthan, it would have a ISD number in Rajasthan, it would have a normal GSTIN in Rajasthan. So from normal GSTIN in Rajasthan, it would raise a RCM payment, right? On the royalty in my example, it would pay through the normal GSTIN in Rajasthan under Rule 39, Sub-Rule 1, capital A, read with Rule 54, Sub-Rule 1, capital A. it would pay the reverse charge mechanism GST, raise a self invoice, and thereafter from the normal GSTIN it would bill to the ISD. Now this input tax credit with the ISD registration gets from the normal Rajasthan GSTIN, it would distribute it across the various branches. This is a clarificatory amendment, what I understand, because even earlier we used to, due to this rule 54(1) capital A, we used to follow the same mechanism for distribution of common input tax credit through RCM. But since the law was getting amended, 261 and section 20, you remember in the budget finance act number 2 of 2024, it got amended. This provision of RCM payment, this was left out. So it seems that this hitch has been taken care of in this Union Budget 2025. One important thing which I would like to present over here is that unlike income tax or customs amendments, which are implemented by enactment of the finance bill, unlike that in GST, even after, say for example, this finance bill 2025, it would be enacted, say for example, on 31st of March 2025. Income tax and customs, the provisions would be implemented from when the enactment has been done. And of course, subject to the effective dates as per the provisions. However, in GST, the situation is a little different. Even after the enactment of the Finance Act 2025, apropos the Finance Bill 2025, the provisions have to be, or amendments have to be ratified by more than 50% of the state legislatures as per the Constitution of India. And thereafter it would be notified, and then the amendments would be construed to have been implemented. However, from our Chamber of Commerce, we have recommended all the taxpayers to take the input service distributor registration, do not delay, and at least if they have not done earlier, to at least go on and from 1st of April, at least from the new financial year, to start this ISD distribution. Second amendment, section 2, subsection 69, right? So what has been amended first, and thereafter I will come to this cases, why this amendment had come, right? On your screen, you can see the case, but I will first deliberate on what is the amendment. So in section 2, subsection 69, there was a definition of the local authority, right? Now, local authority included local and other funds, right? Local fund and municipal fund. So a question arose in many of the cases, like Uttar Pradesh Jal Jeevan Fund was there, and on your screen, New Town Kolkata Development Authority. There is an advance ruling of West Bengal. There was confusion as to this local fund and municipal funds, which was found its way in the definition of local authority in section 2, subsection 69. These funds, what were they? Were all the funds where there was a government, funding, would all of these funds come under local funds and municipal funds, and thus would be a local authority, or there was some specific funds which would be? So in New Town Kolkata Development Authority, the Honorable Advance Ruling Authority had held that this fund, which was for the purpose of development of the New Town area in Kolkata, this would be construed as a local fund, right? So there was some confusion. Now they have clarified this confusion by inserting definition of what is a local fund, what is a municipal fund under section 2, subsection 69 itself, so that whatever funds are construed to be local and municipal funds, they would get the consequential benefits of exemption or lower rate of tax, as the case may be in under various other provisions of the GST rates. Track and trace mechanism. This is a very, very new concept under GST. And what we understand, it has been picked up from international best practices for evasion prone sectors. So we have all heard in the media as well as elsewhere that there are various evasion prone sectors, specifically like gutka, pan masala, etc. And earlier, in the last few years, there has been a special mechanism for these sectors wherein the machines which produce pan masala, gutka, and all such goods which are construed to be or considered to be evasion prone, the production would be calculated and would be tracked. And there are specific returns which need to be filed for these sectors, right? So as to control the evasion, control the supply without payment of GST. But still it was considered that after the goods, such evasion prone goods, even after they left the manufacturer's premises, they were subject to further evasions. Now, following the international best practices, the government has decided to mark with a unique identification mark, which may be a barcode, it may be a stamp, it may be a digital mark or similar other marking on these, either the packets, this pan masala gutka packets would be marked by these barcodes, etc., or the cartons, right, of these goods. They might be marked by these unique identification mark, and a provision section 148 capital A that has also been proposed in this budget. So to subsection 116 capital A read with section 148 capital A, they have been brought to facilitate this new track and trace mechanism, so that the entire end-to-end movement of such goods where it is considered that there is an area of improvement as far as the GST evasion is concerned, and further enforcement in GST is concerned. So the end-to-end, so we all know that generally in the goods part, the supply chain is such that every goods changes 4 hands before reaching the consumer. So generally it is the manufacturer to the distributor to the wholesaler to the retailer, and retailer to the consumer. So 4 hands: manufacturer, distributor, wholesaler, retailer, and then the customer or final consumer gets the goods. Generally, this is the supply chain of the goods in trade and industry. So what the government seems to be proposing, we have read certain international best practices for track and trace mechanism. They are followed in certain other countries. So what we understand is that the government wants to put these barcodes, etc., these marks on the packets or parcels, and these barcodes or marks would have embedded the machine, date, place, factory, shift time, description, quantity, etc. So during the movement, wherever these goods go, they can be scanned and they can be the production details could be had, so that in case there is any chance of evasion, it could be easily tracked. It should be done from in the B2B space till the wholesaler space, and not in the B2C space, because B2C space tracking is very, very difficult. A very, very big amendment which has again been proposed in this budget, apropos the recommendation of the 55th GST Council meeting, is to set to rest the disputes and the certain litigations which were happening in the voucher space. Let us understand for 2-3 minutes what is this GST on vouchers, what is the taxability of GST on vouchers, and what has been done in this budget and what was the dispute. So, under GST on vouchers, the law was that vouchers were defined under section 2 subsection 118 of the CGST Act. What was the definition of vouchers? I'm just not quoting the exact section, just in our for the ease of understanding. Vouchers under section 2 subsection 118, they were considered to be as a payment or part payment for supply of goods or services. Now, the law was that for the vouchers, in case the consequential goods or services which are supplied by payment through vouchers, if they are identifiable at the time of issue of vouchers, then the GST would be charged under section 12 subsection 4 for goods and under section 13 subsection 4 for services for time of supply of services under 13.4 and time of supply of goods under section 12.4. The GST would be charged at the time of supply of vouchers. When in the case when goods and services underlying the supply of the vouchers were identifiable at the time of supply of the vouchers. I will come a little more in detail. First, let us understand the framework. Second, in case the underlying goods or services inbuilt in the supply of vouchers, they were not identifiable at the time of supply of the vouchers, then the time of supply of the vouchers or the GST would be payable at the time when the goods and services were so supplied. So let us understand with an example. Say, for example, we buy a voucher in one of these malls, right? We go to a mall, a multi-storied and multi-product mall, right? And we buy a gift voucher of 10,000 rupees. With that gift voucher, if we can purchase, say, for example, only ready-made garments, and the rate of the ready-made garment, just for example, is all, the fixed, right? So what you are purchasing from the vouchers, GST rate is fixed, and you can purchase only those goods by the payment through vouchers. The goods are identifiable. Then the GST would be charged at the time when you are purchasing the voucher. So you have to pay 10,000 plus, assuming 18% is the GST rate, 1,800 rupees at the time of purchase of the voucher itself. But if they from this 10,000 rupees voucher, you can purchase anything, right? You want to. It can be perfumes, it can be ready-made garments, it can be batteries, etc., etc. So at the time of supply of the vouchers or the purchase of the vouchers, the goods or services are not identifiable. You don't know what GST rate to charge. Then the GST would be leviable at the time of the purchase or the sale of the consequential goods or services are concerned. This was challenged even in the earlier regime and then in GST in the case of Sodexo coupons and vouchers, and it was held by the Honorable Supreme Court that the vouchers are not goods, right? Now the question was whether these vouchers are services. So section 2 subsection 52, it defines goods. What are goods? Goods are movable items under section 2 subsection 52, but it excludes money, right? So money cannot be goods. Now, some of these vouchers, you see, I've given an example of a mall, but some of these vouchers, they are also recognized by RBI as prepayment instruments, PPI. So in case the RBI recognizes these vouchers as prepayment instruments and as a legal tender, then these vouchers take the form of money and therefore they would not be considered to be goods. Even services are anything other than goods but exclude money. Therefore, in case recognized by RBI, these would not be even services. So vouchers are neither goods nor services if recognized by RBI because they are money. Another argument was that why not vouchers can be construed to be actionable claim. So actionable claim has been defined under section 2 subsection 102A, right? So actionable claims as per 202A read with section 3 of the Transfer of Properties Act, that though they are claim to debt. In simple terms, actionable claims are claim to debt, claim to anything in future which you are going to buy. Now, actionable claim are construed to be goods under section 2 subsection 52 of the CGST Act. However, under schedule 3 of the CGST Act, only 6 types of actionable claims, they are considered to be goods. Other than those 6, they are considered to be neither goods nor services. So those 6 items which are construed to be goods, 6 actionable claims construed to be goods are actionable claims in the form of lottery, betting, gambling, online gaming, casinos, etc. Right? And horse racing, right? So 6 actionable claims which are construed to be goods, all others are construed to be neither goods nor services. Therefore, these vouchers are not even taxable as actionable claims under GST. If they are not actionable claim, if they are not services nor goods, either as actionable claim or as money, then it was decided by the council and a circular was also issued, circular 243, which stated that there should not be any tax on what? Now, here there is a small understanding. There would not be any tax on the sale or purchase of vouchers per se. But there are 2 kinds of business models. One is that you are a dealer of vouchers. You purchase the voucher from your principal, right? You purchase, say it's a 10,000 rupees voucher. You are a mere dealer in the voucher. So you purchase it at 9,500 and sell it at 10,000, making a 500 rupees profit. So then it is a mere sale and purchase of voucher. No GST would be applicable. However, say for example, you purchase the voucher on a principal to principal basis and you sell the voucher on behalf of the principal and you get a commission of 5%, 500 rupees in my example. So on that 500 rupees, since it is not a supply and purchase of voucher, it is a rendering of the services in the form of agent for the purpose of sale of the vouchers, then such commission would be taxable under GST at the rate of 18% or appropriate rate as may be there. Next, if along with the purchase, say you are doing the business for sale and purchase of voucher, but along with the sale and purchase of the voucher, you are also doing certain other marketing services, etc. You are displaying the vouchers in your showcase, etc., and you are getting certain fees for that. That would be taxable. What about breakage of the vouchers? What about vouchers which are getting destroyed? There also it was clarified under circular 243 that the breakage of the vouchers would be construed to be under circular 178 and it would be considered as neither supply nor of goods nor supply of services, right? So this is the entire ecosystem which has developed from the council meeting to this the budget 2025 on the vouchers. I've covered all of this in the PPT. You may go through this, the PPT. Now, as Honorable Principal Chief Commissioner Sir has said, major development from November to now, that is in the form of input tax credit under section 17 subsection 5 clause D of the CGST Act. Again, I would try to take you through the entire what has taken place over the last 3 months in this Safari Retreats decision. So what was the dispute? What was the litigation and the consequential judgment of the Honorable Supreme Court in the case of Safari Retreats? The issue was that section 17(5)(d), it blocked the input tax credit on goods or services used for the purpose of construction of immovable property for own use, but it excluded plant or machinery, right? So 3 things: goods and services used for construction of immovable property blocked. When blocked, when these goods and services or these are used for immovable property which is for own use. And number 3, plant or machinery, even if immovable property, they were outside this blockage. If goods and services were used for the purpose of construction of plant or machinery, then it was considered to be allowed. Taxpayers, certain taxpayers are there who constructed warehouses and buildings for the purpose of subsequent leasing, right? So they said that we are using these goods and services for the construction of our warehouses and building, not for the purpose of resale. We are using it for the purpose of providing leasing or renting services for warehouse or building, and therefore these inputs or input services are used for providing taxable services of leasing, and therefore it should be available to us. It was denied. Then the taxpayers came out with an anomaly. You might say it was an anomaly in the law at that point of time. What was the anomaly? That plant or machinery was excluded from this blockage of input tax credit. But what was defined under section 17(5) as an explanation was plant and machinery. Taxpayers said their plant or machinery is not the same as plant and machinery, and they relied on the judgment in the case in various Supreme Court cases, and they said that warehouse as well as building for the purpose of subsequent leasing, they should be considered as a plant for the purpose of the CGST Act. The Honorable ASG, he argued that the word plant or machinery, that was an error in the GST law as far as 17(5)(d) was concerned, and it should be read as plant and machinery. And it also relied, the Honorable ASG also relied on the Honorable Supreme Court judgment in an income tax case in the matter of Anand Theatres. However, the Honorable Apex Court has held that since over the last 7 years of implementation, the words plant or machinery continue the same under 17(5)(d. Therefore, the input tax credit would be available because building or warehouse for the purpose of subsequent lending would be considered as plant. Further, It also distinguished the Honorable Apex Court's order in the case of Anand Theatres, stating that Anand Theatres was only relevant to hotels or theatres, but it was not relevant to warehouses or buildings for the purpose of leasing, and therefore this safari retreat judgment was, I would say, under the four walls of the for warehouse as well as for buildings only. The government and the GST Council deliberated on this in the 55th GST Council, and they decided and recommended to amend the word plant or machinery as plant and machinery, and therefore and this is with retrospective effect. And this is also with a rider of an explanation that this amendment would prevail irrespective of any decision of any court or tribunal, etc. Right? Therefore, retrospectively, they have the law has been amended, and this found its place in budget 2025 proposals of GST also. The safari retreat judgment, therefore, with retrospective effect has been amended. Now, there was a question that what about the current cases? As I said in the beginning of my deliberations, that this as far as GST is concerned, the amendments would come into effect from the date it is notified. So at least it would take till say July or August for the 17(5)(d) amendment to be implemented by notification at the earliest. Therefore, till such time as per Article 142 of the Constitution of India, the Supreme Court's judgment in safari retreats would prevail. So what do tax officers do now? The appellate forums, etc. So the government has also under Article 137 read with, we understand, Article 141 of the Constitution has also filed a appeal, SLP, in the Supreme Court for revision. It has filed a revision of the order of the safari retreats in the Supreme Court for review of this decision. So we understand that the government seems very, very clear, and we've spoken to many officers across that this would prevail even in the current judgments which you may get from the appellate authority. But one point here I would like to also put forth before this August gathering, as well as before the senior officers who are there, is the third point. I said first was goods and services for immovable property, plant or machinery, both negated. But this amendment it still says that even if I use goods or services for immovable property for my own use, only then it is blocked. So one submission before this August gathering is, what about when I do not use it for my own use? In my example, I am using this warehouse or building only for the purpose of subsequent leasing, which is a service under Schedule 2 of the CGST Act. It is not for my own use. Therefore, would this amendment for blockage also prevail for subsequent those warehouses or buildings which are there for subsequent leasing? Because in my legal submission, why this blockage is there? Because for real estate, when it is an immovable property, then you do not charge output tax liability for immovable property sale. But when I am leasing out the property, then I am charging GST on the lease at 18%. Therefore, this should prevail. Just a second, I'm getting a call from DGPS Kolkata. Hello? Okay, so I would come to the other amendments in the GST and customs law. invoice management system, they were, now invoice management system is there. This is a new system. As of now, what happens is that when the supplier files its GSTR1, then it is auto-populated in your GSTR2B. Now, after invoice management system was implemented from November 2024, then from that time, what has happened from when the supplier files it one, it reflects in your IMS. And once you accept or reject the invoices, then if you accept the invoices, it goes to your 2B, and then you can file your 3B. If you reject, then it goes back to the supplier's portal, and the input tax credit is not available in the GSTR 2B of the recipient. So as of now, the law did not have the consequential impact of this IMS. Still, 2B was under section 38. The GSTR 2B was referred to as an auto-populated statement. It is not an auto-populated statement after IMS is implemented. So those consequential amendments were made in the law under section 38, the rules, rule 60, rule 67B, etc., they would also be implemented. So now our, from the Chamber of Commerce, our recommendation before the CBIC is, you see, in the credit notes, there is a problem. In the credit notes, what is the problem is when the supplier issues a credit note. Say, for example, on 28th of February 2025, supplier issues a credit note, and I get it on 1st of March 2025. Then for the month of February, when I get my IMS, I don't know that the supplier has issued a credit note. But in the case of credit note, you cannot keep the credit note pending in the IMS. That is how the IMS has been structured. And therefore, I have to either accept or reject. If I accept, then I have to reverse my input tax credit. If I reject, then the supplier has to reverse the reversal of output tax liability, which means the supplier has to pay with interest the GST liability which it had reversed in the issuance of the credit note. So now that we have requested and recommended before the GSTN also and before the council also, that this the credit note should also be allowed to be kept pending for at least some period of time. So that is still there, and some amendments in section 34 subsection 2. There are three kinds of there are three clauses under which credit notes can be issued under section 34 of the CGST Act. Number one, if there is a sales return. Number two, if there is a deficiency of goods or services. And number three, when the taxable value and tax charge is in excess of taxable value and tax which should have been charged, right? So three clauses under section 34. However, when the credit note is issued by the supplier, the requirement of reversal of the input tax credit for the recipient, that was available only for the purpose of post-sale discount under section 15 subsection 3, right? So now they have brought this by an amendment in section 34 that all kinds of credit notes, might be sales return, might be deficiency of goods or services, or any other kind of credit notes, then when the supplier issues the credit note, then there is an obligation for the recipient to reverse the input tax credit. If the recipient does not reverse the input tax credit, then the supplier would also not be allowed to reverse its output tax liability. So going forward, we have advised to all our members in Bengal Chamber and all the taxpayers at large, credit notes is going to be something which needs a very serious attention in GST, because if you get a credit note of GST, you have to see that your ITC is reversed. If you issue a credit note, then it is also important to see whether the recipient has reversed the input tax credit. Earlier, there was an issue that we don't know that the recipient has reversed ITC or not. But now, after implementation of IMS, it is very clear and the recipient has to act after IMS is implemented, so that plea may not be hold good. So, SEZ. SEZ, when the goods are in SEZ or FTWZ, then before clearance, they exchange hands in the SEZ itself. It was always argued, and there was a question whether within SEZ the sale would be taxable or not taxable. Now that sale within the SEZ or FTWZ before clearance to DTA or export, that has been construed to be neither sale of goods nor services and therefore not liable to GST. Now the question remains that if this is the case, then what about the corresponding common input tax credit? In our view, the common input tax credit for these cases for SEZ, intra SEZ or FTWZ supply, that does not require to be reversed. So as we have seen that as of now, penalty, what happens in many of the cases, it was found out by the government that the taxpayers used to pay the tax and sometimes interest and contest the penalty under section 74, while also there is a case that many a time section 74 was implemented when actually section 73 would have sufficed. There was no reason of fraud, collusion or willful misstatement. But there is also a case of the government and the field officers that many a times the penalty frivolous litigations are there. So to that extent, the government has also for first stage appeal, it has been proposed in this budget that even in case you have an order of penalty or interest plus penalty only and not tax amount, then 10% pre-deposit is required to be made at first stage and 10% pre-deposit at second stage on the amount of penalty. But if you have the demand for tax, interest and penalty, all three, then only 10 and 10% pre-deposit on tax amount, not on penalty amount, right? However, there are certain cases where genuinely section 74 or 73 penalty is contested as not applicable. For such cases, it may be a hardship for the taxpayers. But as far as vehicle detention cases are concerned, the penalty was 25%. Seems now that has been reduced to 10% from 25% also. Now, for 9(9)(c), for combined 9 and as well GST and 9 as well as 9(c), the penalty, the late fees would be combined 100 rupees per day or 0.5% of turn, 0.25% of turnover. Now, as of now, there are separate late fees for 9 as well as 9(c), that is done away with. Quickly coming on to the Customs Act, because time is limited. So there are very, very important amendments in customs law, right? And trade facilitation amendments, I would say. Overall, wide amendments in the customs law, the vision of the government seems to be to increase manufacturing and value additions in India, right? And that is the foundation of a Viksit Bharat by 2047. From Bengal Chamber, we also thank the government for taking many of our recommendations on the reduction in the import duty, not only on raw material, but also on capital goods for production of certain items in India. And the government, we feel they have laid down through this customs tariff, a lot of rates have been reduced, and there were around 22 rates in customs. Last budget, 7 rates were reduced, and this time again 7 rates are reduced. So as of now, there are only 8 rates in customs, along with 0 rate, right, or nil rate, as the case might be. So from 22 rates, they have reduced it to 8 rates in over a span of 7-8 months. 3 very important amendments in customs, I would, which is very important from the trade point of view. First, provisional assessment. When does provisional assessment happens? When certain documents or certain information would come post clearance of import, right? So for example, in case you have a post-sale discount from the exporter, foreign exporter, you are importing. So what you would do, you would do a provisional assessment. And after you get the credit note or the discount from the foreign party, then you would get your assessment finalized. As of now, it was seen in many of the cases that these provisional assessments were pending since long. So now the provisional assessment has been capped under section 18 subsection 1 capital B of the Customs Act. The time limit for completion of provision assessment has been capped to 2 years, can be extended by 1 more year by the commissioner on intimation to the importer. So this is a very, very welcome step. Only this 2 years or 3 years cap would not prevail in case from the foreign country or the foreign authority there is certain documents, information, etc., which are required, or in case the issue is under appeal, etc., there are certain specified cases on which this 2 or 3 years time cap would not be applicable. Otherwise, provisional assessment has to be completed within 2 years or 2 plus 1 years with extension. Another very, very important amendment in customs, and we from the Chamber and Trade and Industry certainly hail this amendment in the customs. We all know that in case you are importing certain goods and you pay that taxes, sometimes many a times what happens, the exemptions are erroneously not claimed during import. Subsequently, when the statutory auditor comes to your premise and it verifies its books of account, they see, array, you have paid higher rate of duty, you did not claim this exemption. Or maybe, you get to know subsequent to the import that you have paid higher rate, you have not claimed exemption. So in that case, as of now, also under Customs Act 1962, there is a provision of section 149 for amendment in the bill of entry. But this section 149 is very, very difficult procedurally, and many of the time these applications under 149, we are dealing with so many cases across India where 149 applications are pending. And what happens is, during this, when we make the application, it is said that bring to us the documents which you had relied upon during import. And that is what provision of 149 says. So it is a difficult process. Now, section 18 capital A has been introduced in the Customs Act 1962, where there will be a voluntary revision. You can voluntarily revise your bill of entry and claim the refund under section 27. But there is a time limit. The time limit is 1 year from payment of duty. That was already there under section 27 of the Customs Act 1962. So this is a very, very welcome trade facilitation, and I would say this is a start of Jan Vishwas 2.0, and across the board deregulation which the economic survey was pointing out to. As Honorable Commissioner Sir has said, an interim board has been formed and settlement commission under the customs has been disbanded, and all the powers of settlement commission, they have been entrusted to the interim board. Last very important amendment in customs is a very, very welcome move again for all those of the taxpayers and the importers who are taking the benefit of import of goods at concessional rate of duty. What is the amendment? So as of now, you are taking the benefit of a notification 50/2017, that is the modern notification for the concessional rate of duty for import of goods. That is subject to IGCR rules, right? So Rule 6 and Rule 7 of IGCR rules, what they mandate? They mandate that number one, you have to file monthly return. Monthly return for what? You have to show when you have imported the raw material or goods, capital goods under IGCR at concessional rate of duty, then how you are utilizing that good, monthly return. So it has been amended to quarterly return. So compliance has reduced. Deregulation again. Number two, and very important, many cases are there across India on this. that the raw materials which you import, you have to make the finished goods and to clear it within 6 months. Now, this 6 months period has been increased to 1 year, right? So within 1 year now, you have to make the finished goods, produce the finished goods, and you have to, uh, you see, clear it. So this is a very, very trade facilitation measure. All those importers who are importing raw materials at concessional rate under IGCR, they would understand and they would take the advantage. From our chamber, we have further recommended that many a times it so happens that I get the raw material in cheap in the foreign country at a point of time. I want to stock it in India. Maybe I require it over a period of 2 years also. So possibly, just like this provisional assessment, the power may be given to the commissioner or chief commissioner, principal chief commissioner to extend this period of even 1 year to 1 + 1 year at least. So that is our recommendation. But overall, at least a start has been made, I would say, in the deregulation space in customs, and many of the rates, I would not go through one by one on all the rates which have been reduced in the customs. There are many rates which have been reduced. Some rates have been increased also. So it is across the sectors. It is there in the PPT. So again, we again from Bengal Chamber of Commerce and Industry, we thank the CBIC, the DGTS for providing us this opportunity. And in case of any questions, I would be available. Over to you, sir.
Thank you, Shri Vivek, for your views and an exhaustive and lucid presentation. And I'm sure all of us have been benefited by it. Now, I would invite participants for the questions, if any. And please ensure that question asked should be relevant to our today's topic. And further, the questions can be asked using the chat box.
I think there are no questions, Ravinder.
I think, sir, the presentation has made things very, very clear. Or people, I think one question has come up, sir. If you'd like to answer, I think it has gone.
Yes, sir. So, sir, Mr. Mandeep Sangwan is saying, what would be the difference between section 18A and section 149 of the customs? Should I answer or
Yes, yes, please.
ADG? Yeah. So, in my view, 18A is a more facilitative provision than 149 of the customs, because one major difference is under section 149, it is provided that in case you want to get the amendment of the bill of entry, then you have to produce those documents which were available at the time of import. And that, what from our experience, creates a roadblock in the amendment of bill of entry under 149. And that is not there in section 18 capital A for revision of bill of entry. So in my view that this 18A should be a more faster and quicker mechanism. There is another one from Rule 9610. Although Rule 9610 is not a matter of today's topic.
So we'll stick to the today's topic only. Questions relevant to today's topic, please. So I think the presentation itself made many things very, very clear, and it was a very, very well explained presentation. So I don't think that any more questions are, relevant to the topics are coming up. So I think it was a very good experience for all of us. And in a very short span of time, we have been enriched with all the, information of GST and customs related proposals in Finance Bill 2025. And credit goes to all the presenters as well as the participants, without whom this webinar would not have been a success. We extend our heartfelt gratitude to Shri Mahindra Ranga sir for taking out his time from his busy schedule to enlighten us on the topic and putting in an effort for making this session meaningful and enriching. Your contribution to the discussions were invaluable, sir, and we are grateful for your involvement. Thank you, sir. We also thank our respected ADG, sir, Shri Amish Kumar Gupta, sir, for sharing his experience with us. Sir, your words of encouragement are always a constant source of motivation for all of us. Thank you, sir. And now, on behalf of DGTS, DZU, and KZU, I take this opportunity to propose a word of thanks to those who have directly and indirectly contributed to this webinar and organized by our zonal units. And also thanks to Shri Vivek Jalan for sharing his valuable experience and presentation that made us understand the topic so very well. In the end, I would like to thank all the participants for their support and time for the webinar. Thank you all. Thank you so much.
Thank you. Thank you.
Thank you.